I'm Mikhail Zverev. I'm one of the managers of our Global Innovation Fund. We are a guest appearance / support act. I think we've been to the previous AGM, so some of you might know us, but for those who don't, we joined 2.5 years ago. My co-manager, Graham Benke, and I had long careers, about 25 years, culminating in running big global equity franchises and companies like Standard Life Investments or PineBridge. And we wanted to do something more entrepreneurial, run money the way we'd like our own money to be run. And we were looking for a new home. And Amati was a very logical place for a number of reasons. One, I actually started my buy-side career working with Paul on the Smaller Companies Fund and the VCT when we launched it. So I'm a shareholder in VCT for almost 20 years. It'll be 20 years next year. My shareholder number is 700 something, so somebody got in front of me, but that's okay. It's been a great journey. So we wanted to go somewhere where we know we will have a great home. We're also thought, and I'll expand it a little bit more, that if you're running a global innovation fund, which is what we're doing, there's nothing better than work alongside people who invest in the sort of innovative companies that you've heard of or you heard from earlier. You find what's happening at the leading edge of something when it's usually small, and you're getting closest to it when you invest in smaller companies or you fund these companies through a VCT transaction. So we all remember the time when ARM Holdings was a small cap UK company that told the world that the future of computing is mobile, and look what happened. And there are many other examples like that that taught us that having this proximity is really helpful. So we launched the fund 2 years ago. We just turned 2 a couple of weeks ago, and it's going really well. And I'm going to quickly tell you what we do and what the fund looks like, but I'm going to spend most of the time talking about what we find most interesting. What are the innovation frontiers, as we call them, where we see most opportunities. And these are not recommendations to buy any of the stocks in question, and the disclaimer attends to that. But these are the things we like the most. So we invest in pioneers, enablers, and adopters of innovation, companies that either invent things or provide picks and shovels to the inventors, or adopt these inventions in their businesses and become more valuable businesses as a result. So it's a slightly broader approach to innovation. It has a number of really interesting benefits in how you find ideas and how you build a portfolio. Why we're doing this? Because it almost goes without saying that innovation creates a lot of value. There's sort of inventions that have a potential to change the world, unlock new markets, accelerate growth, win new market share if you do them right. But it's also systematically mispriced, and that's fantastic news for stock pickers like ourselves, because we like things that create value, but that they're not fully priced. They're not. Sometimes they're overpriced, and that's we avoid those. Sometimes they're underpriced, and that's what we're looking for. So it's a really interesting what we would call opportunity set for stock pickers like ourselves. To tackle that, we need a discipline. In fact, a number of disciplines that I think are integral, and some of them have been somewhat out of fashion in the go-go years, but we didn't forget them. One, we need to embrace complexity. We'd like nothing more than discussing what is the value of data in diagnostics labs and why precision medicine requires companion diagnostics, as you've heard before. We're well equipped to engage with that complexity. We're a team of 3. Effectively, Gareth, who you know from the VCT, is also helping us on the healthcare side. So we've got a biotech PhD, a former RAF fighter pilot who's expert in all things aerospace, and semiconductor physicist myself, who love researching this area. But we also don't forget that these companies have to be real businesses, not science projects. We're looking for companies that fund their own way, they're cash generative, they're profitable, and they're reasonably priced. And in boom years, that you can dispense with that discipline and then regret it when things return to normal and interest rates are no longer zero. And both Graham and I worked and lived through the dot-com boom #1. So we felt that discipline is important through the cycle, and it's particularly important in this current, more uncertain economic environment. We think we bring something to the table in capturing that opportunity. Like I said, our academic backgrounds and our professional backgrounds are quite aligned to that. But we love doing this at Amati because we are in the proximity of really interesting companies, some of them in the smaller companies portfolio, some of them in the VCT portfolio. We know these companies really well. We hear things happening at the leading edge of the industries, which, dare I say, our global equity brethren from our previous career journeys would only find out when they become multi-billion businesses. And we take that knowledge and we bring that to the global equity world and say, okay, what do we know that the market doesn't fully appreciate? And that's been already, we knew it was going to be our edge, and we've been pleased by how well it served us and our clients in the first 2 years of our lives. The result of that is this fund, and I'm just going to get out of the way so you can see all these numbers. We are not a technology fund. We have 6 sectors in the portfolio. Innovation happens everywhere. Predictably, healthcare, industrials, and technology are very big sectors for us, but we have ideas in materials, for example. We have a company that makes sticky labels for parcel boxes that we think is at the beginning of something really interesting on what's happening in the global semiconductor world, and explain why it matters. We follow innovation where it takes us. We are not going to be another fund that gives you a magnificent 7, a slightly different mix. We want to find less discovered or undiscovered ideas that make money from innovation. So the result of that is we're a liquid fund. We're all listed companies. We typically start from $1 billion market capitalization and high. We can go all the way to the largest companies in the world. We have that liberty. But the weighted average is about 60 billion. So liquid, but not mega cap. And this clear valuation discipline, which is marked up as white against light gray. So I'll have to read it out for you. Our PE ratio is 21 times. Our free cash flow yield is 4%. That's very respectable, considering we invest in this high growth, innovative companies. And our typical company's earnings growth, according, these are all consensus numbers, is 21%. So we're growing meaningfully ahead of the market if these numbers are correct, and we're not overpaying for it. And we're very different from benchmark. Our active share, which is a metric that shows how different are we from the index you can buy for 0, typically was between 98 and 99%. So we had virtually nothing in common with the global benchmarks and the passive funds. And that's, I think, what we need to do as active stock pickers. So where are we looking for opportunities, and where are we finding them? We have this concept of innovation frontiers, which, think about this as an area of innovation where something is really valuable is happening. It is happening. We're not imagining the world in 10 years' time with flying cars and mining minerals on the moon. Hopefully not, because our metals colleagues, their companies are mining minerals on Earth very successfully. But we're seeing something that is working today. Industry is adopting it. We started the presentation with a quote, "The future is already here, it's just not evenly distributed." That's the kind of future we're looking for. It's proven beyond reasonable doubt that this innovation works technically, and it created valuable business models. It makes people money. Now we just ride the adoption curve, the proliferation curve. So one of the areas we're really interested in is photonics. And you may have seen there's a photonics company in the VCT which makes LiDAR for wind turbines. We may have covered that. We're also really interested in photonics in many different places, in particular in data transmission. We use and need more copper in lots of places, but increasingly we're going to use less copper where we transmit data. We just can't, the copper can't cope. Just like your household broadband had to switch from dial-up copper to the home to effectively fiber to the home, and now looking at fiber in the home, everywhere with this NVIDIA's AI data centers or corporate networks, the speed with which we need to ship data and the energy consumption of that data being shipped at that speed means you have to switch from electrons in copper to photons in optical fiber. And we have it's a really interesting small, if you like, cottage industry of very profitable businesses, and we own 2. Lumentum, which makes lasers that identify your face if you pick up your iPhone. They do that photonics bit, the Face ID, but most of their business is supplying this communication lasers to data centers and telecom companies. We're also on Fabrinet, which puts all these things together. They are ultimate pick and shovel supplier. They, effectively a contract manufacturer. But this photonics workloads are so difficult to get right. You have to do it in clean room. You have to calibrate these lasers very precisely. They're brilliant at it. In fact, they're pretty much the only game in town, as the industry would refer to them. We're very interested in the pace and accelerating pace of drug discovery, and our colleagues from Bioceutics alluded to that. We're seeing explosion in new drugs coming through, and yes, they come increasingly with companion diagnostics, so it's worth having companion diagnostics alongside them. But increasingly, they are not chemically synthesized like the small molecule drugs of old, but biologically produced. They're fermented, they're bioprocessed effectively. And you're effectively switching from a chemical plant to a brewery. And we own the company that is the best supplier of brewery equipment for this bioprocessing facilities Danaher, where this mammalian cells or the specialist, genetically engineered bugs are producing this monoclonal antibodies and increasingly producing cell and gene therapies. They also have some fantastic diagnostics equipment, so other parts of their business are very much aligned with the opportunity that Diaceuticals had talked to you about earlier. No presentation today is complete without AI, and this is when the technology fails me. And we are interested in AI. We owned NVIDIA. It was a good contributor to our return. We sold the stock. But we think there are other ways to take advantage of AI growth. We think memory semiconductors, which is an oligopoly of three, is really underappreciated beneficiary of AI. Not just because every NVIDIA chip comes with very large and very expensive memory chips, which SK Hynix is making, so they're literally growing one for one with NVIDIA GPUs. But also, we just had Apple launch their AI assistant, if you like, on the iPhone. And the eagle-eyed amongst you would have noticed that unusually they specify that this AI, Apple Intelligence, as they call it, would only be available on iPhones with 8 GB of DRAM and higher, because AI is very memory consuming. And we're going to create so much more data because now we know we can extract better answers from it with AI. And that data will be stored in chips that Hynix and Samsung out of South Korea are making. Sometimes our innovation frontiers take us to pretty prosaic places. For example, we looked at great length at the explosion of alternative energy generation options available, whether it's wind turbines or solar power, potentially nuclear modular reactors, small modular reactors, which is still an unproven technology, but there's lots of money going into that. We also looked at lots of new ways of using energy, electric cars, heat pumps to replace your gas boilers where it makes sense. But the common denominator to all this for us was the way we produce energy becomes more and more widely distributed. In our hometown of Edinburgh, you go from a coal-fired plant in Tranent, which has now been demolished, to lots and lots of wind turbines in offshore Inverness. And the length of the cable to ship that electricity to Edinburgh has gone up exponentially. So we own a company, a global leader in making offshore, underwater, as well as onshore high-voltage cable, Prismin. We also own a company called Mastec. By the way, that problem in the US is orders of magnitude greater than it is in the UK, and we're just beginning to tackle it. We are also a company that builds electric grids. They're a construction company, a very specialist one. Specialist skills and specialist equipment, very hard business to break into. And these are superficially prosaic companies. They do pretty basic things, but they are the keys to the kingdom, if you like, of unlocking both renewable energy or more diverse sources of energy to feed our incessant demand for energy, laterally added by AI data centers, and also enable more and more energy use in our communities through the distribution products, because nothing in your house will be as consumptive of energy as your heat pump and your electric vehicle would be. So you have to upgrade this network as well. And sometimes our ideas take us, I promised you the sticky labels story. Sometimes our ideas take us to very unusual places. So we're really interested in RFID. And some of you may have experienced RFID. If you go to Uniqlo or Decathlon, to buy a pair of shoes or a jumper, you increasingly find that you're not scanning, or a retail associate is not scanning a barcode anymore. You just drop everything into a little bucket, and somehow miraculously the system knows all the 10 items you've purchased. They all are tagged with RFID tags, and the RFID reader can read thousands of this per minute without line of sight, with ever greater precision. And that's just the tip of the iceberg. We're seeing these things emerging as ways to control integrity of distribution chains in areas like pharmaceuticals, precision of assembly of cars on the construction. Most of the tires from Michelin are now coming with RFID built in, and all the tire makers are following. So on one end, we own Impinj, which is the inventor, effectively, of this technology. They own RFID. There's only two companies who can make it, and one is Impinj, they invented it, and the other is their distant second competitor who pays them royalty for the IP. But also we own Avery Dennison, because every sticky label on the UPS parcel coming to consumers' by the end of this year, beginning of next year, will now contain RFID, because UPS figured out that the cost of missed shipment and even the cost of manual labor of scanning their barcodes is such that they're better off integrating this little mini computer, effectively, this tiny semiconductor, into all their sticky labels. And Avery Dennison is the company that does it for them. So this is just a kind of a feeling for what we're looking for, where we're finding opportunities, the kind of the level of depth that we go in identifying that. We're only 2 years old. We have a 3 to 5 year time horizon. So we're pleased with how we started. Our companies are just beginning to prove their worth. And we had a good year. We had a good 2 years. We've outperformed our peer group significantly. We're pleased with that. We seeded this fund with our own capital. So managers, significant proportion of managers' capital is, in fact, most of it is in this fund. But we're also very pleased with the support we got from many Amati colleagues. So we definitely are asked difficult questions if the fund is not performing. And we look forward to, over time, maybe present this to you as something else to consider for your portfolios. So that's us in a nutshell. Thank you very much. And I think I'm within my time. I'm not sure if we're doing Q&A, but great. I'll pass it on to I'll pass it on to George to talk about mining. Thanks, Michael.
Thanks, everyone. I realize I'm between you and the drinks and canapes I saw on the schedule, so I'll try to be quick. And I brought 37 slides, so I think they're going to be available to you. So I'll rush through a lot of slides, but I'll just point out a couple of key points. This fund, I think Mikhail said his fund was launched just over 2 years ago. We launched just over 3 years ago. Also this is the third fund that I've actually started, and it was, I think, and I'll show you the reasons why we think it's a really interesting space right now. It's the only fund of its kind in the UK that we invest right across all the metals, what we deem to be strategic for the economy going forward. And we focus really on the medium cap growth companies rather than the large caps that are just sitting waiting for commodity prices to move up and down. This is good and bad, and you'll see the bad because in the last year where nobody cared about the sector, and I think still today nobody cares about, as a value investor you're sitting with great companies trading at big discounts to their fair value, whereas the macro funds, the only guys who are playing it, are looking for momentum plays, and they're looking for sectors themselves rather than value in the sector. We like the exploration, companies with exploration upside, with development risk that they're unlocking, and a lot of the companies that are producing but have got projects in the pipeline. So we actively manage this. Everything is modeled from the bottom up. We have over 200 companies that we model, and we constantly looking at the value right across the suite, and we're really focused on value, where we're saying, why is this sector trading at such a big discount given the metals that we see in front of us? We try not to predict metal prices. We look at the gold price, the silver price, what we see on the screen, and we look at the discount, say, why is that discount there, and where could the opportunity and the risk lie? And the same we do with the base metals. We look at long-term sustainable metal prices and where these companies are trading relative to the metal prices. And it's a really interesting sector because we've got the decarbonization of global energy taking place right now. We've got renewable energy that's all metals intensive. It's sort of creating this massive, and I think this is the problem. I think I spoke to a couple of large mining companies last week, and they're saying the reason why they're not developing some of these big projects is they don't know where we're going to go. They haven't faced a metal that's going to increase in demand 20-fold over the next 5 years. That's on lithium. We've got nickel increasing 5-fold. These are, we're dumb miners. I'm a mine engineer as well. We're used to just steady growth, and suddenly we got these big numbers. And to be honest, the last 5 years has been really difficult in the mining sector. We went into COVID, we had a hiatus in spending taking place. We had mining companies reducing their production because they couldn't get enough workers, they had to change the schedule. We had supply side issues, and then coming out of that, we had all this capital that was saved being spent, so you had the increase in demand coming back, and then you had inflation and knocking onto the cost. So it's been an extremely volatile period, and I'll show that as well. So what's happening now, and I said we're focused on value, and today, actually this morning, one of our companies, I think it makes it the 11th company that we've invested in, and we keep a tight portfolio, that's been taken out. That's Trident Royalties was taken out this morning. All cash offer. It was a nice premium, 25-30%, but it was still well below the fair value, and that's what we're finding. We're doing the right work, but we're not getting the real value being unlocked. We said we'd have about 20%, 15, 20% in precious metals because there's a lot of growth in that area, there's a lot of opportunities to invest. But right now, given the global political risk and the record debt levels, a lot of appeal as a safe haven appeal is prevalent in the market, and that should drive metal prices higher. But also, nobody cares. It's a completely underappreciated sector where we're getting EV to EBITDA multiples of 2-3 times on companies that have 20 or 30-year life of mine. This is my 30th year of doing this, and I've never seen those kind of valuations. So I'll quickly run through. You can see my colleague Mark Smith and we co-manage the fund. Mark is a geologist. He's also got a master's in mineral projects appraisal. I'm a mine engineer by background. You can see our time that we've had in the investment banking or the investment side of the business. And we both spent time working on mining companies underground and Mark in the field in West Africa and East Africa. And what we do different is we actually go out and kick the tires on this. These are some of the reports. I think they're outside. I saw some of the reports from the trips. And I highlight these two, G Mining and Reunion and G2 Goldfields. We're one of the few investors that went out there, and it's worked out really well for the fund. So this is really why we kind of get excited here. This is the Goldman Sachs Commodity Index against the S&P 500. And you can see these big waves. And you can see the index. I mean, that's from 1 up to 7. We've kind of gone through in waves here. So since the financial crisis in 2008, you really didn't want to be in the mining side. We launched the fund here at this green dot here, I think 2021. And we initially had a nice run and then sort of pulled back. But looking forward, we know the needs that will come from decarbonization, the adoption of EV. Mikhail mentioned as well the grid infrastructure. That's a big theme that's taking place at the moment. I put AI in there as well. Mikhail, I didn't know you had it. But we're all talking about it, that we need more capacity on the grid, the charging infrastructure layout. And on the precious metals, you've got de-dollarization taking place at the moment, and the safe haven appeal is growing. We all know that the gold and silver is starting to break out. This is really interesting. We're getting near the time when investors get excited about gold and silver shares is when we start seeing the first rate cut. Yesterday, we got rates were kept on hold. From 3 rate cuts this year, the Fed's indicating maybe 1 rate cut in September, but a lot of investors are saying, well, I'm not going to look at the sector again until we have some rate cuts in the horizon. Historically, that's the way to play it. When you got rate hikes, you don't want to be in gold or silver, and when you got rate cuts coming through, that's typically when they perform well. But that hasn't been the case this time around. China, especially the Chinese central bank, have been massive buyers of gold in the last 2 or 3 years. The gold price actually gone up, while real rates have gone up as well, which is quite unusual. And you can see it's not only central bank, but the Chinese households have been buying as well. Chinese central bank, you can see the extent that they've been buying. It's been consistent now since 2023. And I wanted to point out, you can have a look at this, it's got about 4.4% of their foreign reserves in gold. They actually wanted to have a much higher percentage, but they feel they're just driving the gold price higher. And I think they put a pause last month on buying of gold, but they'll come back. By comparison, the European Union, Eurozone area, has got 56% of the foreign exchange reserves in gold. So this is where China wants to get to. But you can see it's been a long, this is central bank holdings of gold, and this is their holding in US treasuries. And you can see there's been a deliberate shift out of treasuries into gold, and that's been taking place for about 10 years now. Meanwhile, in the West, we've been following what's happening in real interest rates. You can see that's inverted. So real interest rates have moved to +2. And what's happened is you've had a lot of selling of gold in the form of ETFs in the West. That's in Europe and in the US. And that selling has almost equated to what the Chinese central bank has been buying. Now it's getting quite interesting because we're getting to a situation where interest rates are probably going to come down rather than up, which means real rates are probably going to go the other way. They're going to start going down again, which means we're going to get a slowdown, and we've already seen a reversal of ETF selling taking place in a market that's quite tight. And part of the reason why gold is increasing its appeal is because of the debt levels. I won't deal too much on that, but you can see the rise in the debt in the US, and you can see what happens if interest rates remain where they are in the US. The interest on the debt will go from 1.1 trillion, that's 12-month cumulative, to 1.6 trillion by the end of this year. This is something that some of the big hedge funds and macro funds are looking at. So we always ask ourselves, is the market looking a bit toppy? We've had a little bit of a pickup now in gold and silver shares, and the gold price has certainly moved quite significantly. But you look at this period, in 2011, about 9% of all the ETFs held right across all sectors was held in gold. We're now sitting at 2%, which is the second lowest on record. I saw a graph from US over the weekend showing that the family offices, on average, hold 1% of their assets in commodities, and that includes oil and gas. That's the lowest on record. But the gold miners, and this I showed that margin because we had about $2,300 an ounce at the moment, and that's the all-in cost to produce an ounce of gold. We had record levels. The profitability levels of the sector is at record levels. That's why we're getting EV to EBITDA margins of 2 or 3 times. And this is quite interesting as well, is that this is the gold price moving up. We'd expect it to have come down with the interest rates going up, but it carried on going up with Chinese buying. But the equities kept on discounting about $1,600 an ounce. And today it's about $1,700 to $1,800 an ounce is where the market is. So we're agnostic. We're looking for value. And there's about a 700, it's actually higher than that. It's closer to $800 an ounce discount that's implied in the equities right now. So for us, something's got to give. We've got to get a reversion to mean somehow. And that includes the large caps, which are trading at about 0.8. But the developers and the smaller medium caps are trading about 0.6 times. Why do we care? Well, we can see the last time, 2015, we had this is the equities against the gold price. And we can see when we had a turn in the gold price here, the gold was up 25%, the equities up 148%. The same happened in 2020, where the equities up, 111 against the 27% in the gold price itself. This time round, we've had a muted response to the gold equities, but that's kind of stimulating a lot of M&A activity right now. Silver, I don't want to deal too much, but we're really excited about silver because you saw what happened in the uranium market last year, is where uranium went through the same period of supply deficit for 4 years before the market woke up. And the uranium price went from low 20s all the way over $100 a pound. We got the similar situation in the silver, where you've had 4 years of deficits being supplied by ETF selling and by above ground reserves. But silver is actually an industrial product. You can see 55% is industrial application. A lot of it is from the solar panel industry and also from the EV market, which is really driving demand for silver. And meanwhile, production is falling. You can see the big fall in production. 70% comes as byproduct. That's not going to reverse itself. I'll put on the other slide. I'm going quickly through these slides, but you can see the increase in silver and demand coming through. So you've got rising demand, falling production, 4 years of deficit. The supply response is difficult, and the price is suddenly breaking out of a 10-year hiatus. Yet when you look at the valuations, all these stocks used to trade at 2 times net asset value. We've now got the large guys at 0.72 times net asset value on average. The price to cash flow of some of these even large companies, you take a company like Fresnillo, the gold price this year is up 22%, up about 14%. The silver price up 22%. The Mexican peso in the last few weeks has weakened considerably, 10, 11%. So their profit margin has now increased 500-fold. And the stock is actually down year to date. So it just shows you how neglected the sector is right now. Quickly just touch on the EV market, because this just graphically, I like this slide, which just shows how China dominates the EV market. You can see last year we had a 32% increase in global demand for EVs. It's been a slower year. We've definitely got a reset for the EV market. The market is from euphoria, it's getting a little bit more settled, lowered expectation, but we still have a 21% increase at these current rates for this year. This is the kind of graph that mining companies are looking at. And this is what these cell manufacturers, the plants that are being constructed today, are expecting from the mining industry. So I asked them at the conference last week, I said, all these great plans, this was a downstream conference, you're building all these cell plants, where's the metal going to come from? I said, well, we're just hoping that the mining companies are going to give us that metal. So this shows you just the capital that goes into the EVs, capital goes into batteries, and that's the money that's been going into the raw materials. But it takes typically 15 to 20 years to develop a mine from today. So we're looking at these kind of situations where lithium went up, came down, it's now at about 14. This is from BMO Capital. We've got a few years that might be oversupplied. Nickel as well, those numbers are coming down, the oversupplied, and then massive deficits coming in the future. And those mines had to be started a few years back. And right now, we've got, of the spodumene which feeds into the lithium, 50% of the mines are sub-economic. On the nickel side, we have as well 50% of the mines sub-economic. We're getting mine shutdowns. So we know that these prices are not sustainable. We're probably going to get a little bit of a pickup in prices. So just to leave you the big picture thinking, you can see the sort of demand, especially lithium, nickel, graphite, and rare earths that we're seeing in the coming years. We like to be invested over here with the project development. This is the discount to fair value curve. So they get the discovery, the market gets into doldrum as they finance the company, and then as they move closer to production, you typically go from 0.2, 0.3 times net asset value to a premium. This is just shows you a little bit of how you can actually make money by being in the right stocks here. This is G Mining Ventures. You can see it's a development company. It's up 120% in the last year. It's just made a bid for Reunion Mining, which is on the right-hand side, and right next to Reunion is G2 Goldfields, which is Anglo Gold, bought 11.7% of the company quite recently at 90 cents a share. They've come back. They've been buying the market at 134. Today it's 139. So it's clearly there could be somebody coming over the top and taking these companies out again. And this is just an idea of G Mining Ventures over time, how it's grown into the company it is today. It's got a project that it's busy producing. The first gold will be in a month's time, and they've just bid up here. I don't know if you can see it up here in Guyana. They made a discovery of probably the biggest gold discovery in the last 10 years between Guyana, between Reunion Gold and G2 Goldfields. But G Mining Ventures developed successfully the mines in Omar, Rosebel, and Meridian for other people before they became their own mining company. So this just, we can discuss after time. I've run out of time here, but that's Reunion Gold, and that's G2 Goldfields. You put that whole camp together right now, it's just under 8 million ounces. The market feels it's going to be about 15, 20 million ounces. So whether Anglo Gold or another party come in over the top and take them out. But you can see the grades as well, 9 grams, 6 grams. This are very high grade. The projections at the moment for G2 Gold, for G Mining, is that they'll be producing 600,000 ounces a year at $800 an ounce all-in cost. So you can see it's going to be one of the most profitable mines in the world. And it's still trading at 0.6 times net asset value without having bought a Reunion. So there's a lot of upside in this company. This is just the asset split. You can see we're looking opportunities right across the spectrum. Gold, silver. We're more overweight than we really want to be, purely just because we're seeing so much value in the sector right now. The average market cap is about 1.5 billion. We have 38 companies in the portfolio right now, and that's a split between explorers, developers, and producers. These are top 10 holdings. I'll go quickly through that. It's in the presentation pack. And it was a difficult year. We had too much in the lithium, even though we expected lithium prices to come down. We thought we'd buy the best companies out there. They're still very good companies. They just went from 0.2, 0.3 times net asset value to 0.1, 0.2 times net asset value. We're doing the same in the nickel. I think we've got 3 of the best nickel companies in the world in the portfolio, trading at very, very big discounts to fair value. So just the outlook, you can read it there. It's the implications are that for the market has actually moved more into the industrial metals. So copper, they've moved into uranium. We looked at that sector. We were in copper. We were in uranium. We maybe got out a little early. They're susceptible to the Chinese growth not materializing. But the EV and the renewable energy sector has gone full circle from euphoria to actual despair right now. So that's where we're seeing a lot of our valuations, and we're going to continue to be selective across the whole industry. So I've left it. I don't know if we're going to have some questions. I'll try to get it through very, very quickly. There's a lot of slides, but I'm available to chat more. I mean, we're kind of excited because we probably had too much in the EV sector that came down last year, and that hurt us. There's no way to hide it. But we've kept on top of these companies. We've gone out to see them. We've very happy with the valuation. Now, lithium prices are actually up about 15% from the bottom, and I showed you because the companies are not making money at these low levels. But the valuations are about 2.2, 0.3 times net asset value. So you're starting to see some money flowing in. But this is still a hugely discounted sector. So I'll give you just a quick snapshot. Thanks.
Fantastic. Thank you, George. So we, yeah. Thank you very much also for staying through the presentations. I hope you found that interesting. It's fantastic for me having the new teams, having joined Amati over the last few years, because it's really broadened out the kind of discussions we can have internally, and it's covering lots of areas that I've always been really fascinated in and interested in, and having this broader team is I think wonderful for our business, and hopefully this has given you some insight into these other funds that have appeared on Amati's pages. So I'm very pleased to say now we can have some canapes and drinks. They're going to be next door. Fortunately, weather forecasting is easier than market forecasting, so we did think it was going to rain, and it is kind of raining. So sadly, we're not going to go outside this year. I'm sorry about that, but look forward to seeing you all next door, and we can carry on the conversation there. Thank you.